In this video, we're going to explore what stocks actually are and how they work. Just about everyone who invests owns stock. But do you know what stock actually is and what benefits owning stock gives you as an investor? Well, this video is for you. At a fundamental level, stock is ownership. A particular type of ownership designed to allow multiple parties to own a company or organization. Throughout human history, almost all private business was owned by a single owner, either a person or a family. Think small artisanal shops, family farms, etc. Any idea larger than that was usually controlled by the government, who was the only entity with enough resources to fund larger enterprise. However, with the advent of the Industrial Revolution came a need for a system to fund large-scale companies building factories and heavy industry. Corporations are the solution created to facilitate joint ownership of large commercial projects. Corporations, from the Latin corpus, meaning body of people, is a legal entity that, while not an actual person, can buy and sell things, own property, enter into contracts, and pay taxes. Corporations essentially abstract away all of the actions needed to conduct business from a person to the entity itself, resulting in limited liability. Limited liability means that employees and owners of a business aren't held personally liable for the debts and obligations of a corporation. This construct allows the opportunity for people to invest in a business without risking their personal financial security. For example, if you owned a single share in a company, your entire personal wealth wouldn't be at risk should the company you own a single share in go bankrupt. You would at most only lose your investment. Corporations do more than just abstract away risk, however. They allow for large-scale investment in and governance of enterprise, and stock is the mechanism by which that is achieved. Stock means ownership or interest, and shares refer to one's share of stock. Shares of stock in a corporation grant the shareholder financial and governance rights. Shareholders are entitled to any dividends, residual assets from bankruptcy after all debts and taxes are paid, and all proceeds in the event of the sale of the company. Furthermore, all shareholders get a say in the governance of the corporation through two methods: directly voting on shareholder proposals and electing the board of directors, who hire and fire the CEO and act to oversee the company on behalf of the shareholders as proxies. So, what determines your dividends or votes? Simple: the percentage of stock that you own. Imagine a company has 100 shares and you own 5 of them. That means you own 5% of the company, and you are entitled to 5% of the dividends, 5% of the proceeds in the event of a sale, and 5% of the voting rights in any shareholder decision. A note: if you have stock in a company through an index or mutual fund, you don't actually own that stock. Rather, you own part of a fund that itself owns the company's stock. However, if you buy shares directly through a brokerage, you do have all the benefits of being a shareholder since you actually own the stock directly. Stock is a bedrock concept of our modern economies. This joint investment and ownership allows for everyday people, not just aristocratic families, to participate in large-scale enterprise and financially benefit from that enterprise in a fair, systematic way. Thanks for watching.